New housing market data from this week shows that weakness is growing in the market and we could be heading towards a historic correction or even a complete housing market crash. Things are about to get really interesting, and today I'll be showing you the key data points and metrics surrounding the housing market that have emerged in the last few days, and also why this could be bad news for the housing market overall. So first of all, house prices are falling quite sharply. So weakness is continuing to show across the entire housing market. However, perhaps the most alarming metric at the moment is the new home sector. So the average sale price for new homes sold in the US has dropped off a cliff over the last few months, and it's now dropped from around 569k in April 22 down to 456k in June. So this is a staggering 112.5k decline in average price for a new home. Now that is a 20% drop in just 2 months, one of the sharpest falls that we've seen in the new home market in history. Now obviously the new home sector only makes up a portion of the total housing market. However, new homes are usually the most desirable places for people to live on the market. So seeing a drop off of this magnitude is definitely quite alarming to see. So unfortunately, data from the same source was not yet updated for the entire home sector as a whole. This is updated every quarter, and as Q3 is not finished yet, we can't look at this just now, but this is something I'll be keeping my eye on in the future. However, Redfin did also provide some updated housing market data from the research they have carried out over 400 US metro areas, and this data is for the entire housing market, and it also does back up that house prices are indeed starting to fall. So firstly, looking at the median home sale price, it continues to decline from the peak that we saw in mid to late June, and is now down 3.8% at just over 380k. This is still up 8% from last year. However, there is now a clear downwards trend that is taking place after falling consistently for a month and a half now. So additionally, the median asking price for newly listed homes is steadily dropping as well, and it is now down to just over 394k, which is a 2.6% fall from the highs that we saw at the end of May. And again, this metric is also forming a consistent trend over the last few months, showing that there is a clear weakness in the housing market, which new sellers are simply not able to sell at the prices that they once were able to back in the May 22 time period. There has also been a sharp drop-off in the price that homes are selling for relative to the listing price. So back in 2021 and early 2022, we did see that the housing market became so red hot that many buyers were paying above the asking price in order to secure the home that they wanted to buy, and the average home was selling for above 102% of the listed price. So this was because there was such a high demand for homes compared to the supply that in order to have your offer accepted, then you did need to put in a bid that was above the asking price, as there was a lot of competition and many other offers coming in that you had to compete with. But now the market is starting to cool off, we are seeing that this figure is dropping quite drastically, and it has now fallen from over 102% in May to just 100.8% just a couple of months later as of July. So this is quite a sharp fall over a short period of time, and the figure is fast approaching 100%, which would be the flat listing price. Now personally, I believe that this could even go below 100% in the future if the demand and supply balance really changes, where we see sellers taking offers that are lower than the asking price in order to get their sale through as fast as possible. So this brings me on to the next main point, which is the supply versus demand, and how this is shifting in the favour of supply. So we know that the average home price is continuing to gradually drop, and we have been trending downwards for a couple of months now in this metric. However, there are also various other interesting metrics that we can look at that further show a shifting pattern in the supply of homes as well as the demand for them right now. So continuing to look at Redfin's research, we can see that the number of listings that have had price drops continues to surge, now at 7.7%, which is significantly higher than any time in recent history. So people that are selling their home are clearly having a hard time selling right now for the price that they originally wanted, and are being forced to actually drop their asking price in order to find a buyer. Now, further emphasising this point, active listings from Redfin's research also continue to rise and are approaching levels last seen in 2020. So active listings have now reached just under 820,000, which is much higher than the lows that we saw back in early 2022, which was in the mid 500,000 range, and it's also up 4% compared to year over year. So a rising trend in active listings is a negative sign for the housing market and shows that there is a growing weakness in the market. So this is because it means that sellers are having a harder time selling and are having to wait longer to make a sale, possibly due to there not being enough buyers out there right now to match the incoming supply. So if the market was red hot, like that we saw in 2021, then homes would be flying off the shelves and deals would be actually getting completed a lot quicker, dropping the overall number of active listings. On top of this, data from the St. Louis Fed database also shows that active listings, also referred to as housing inventory, is on the rise. Now, although the last data point is in June, we are approaching double the housing inventory compared to the lows in February earlier this year. So we're still at a low inventory level relative to the last 5 years or so. However, the fact that the inventory levels have been rapidly increasing in recent months is not a good sign for the housing market. Now, all of this data does suggest that the supply of houses is increasing while the demand for houses is decreasing. So supply increasing could be down to homeowners wanting to sell up as soon as they can in fear of the housing market and overall economy getting worse in the future. Or maybe they are simply finding it hard to keep up with mortgage payments due to the rising cost of livings and stuff like that. And then demand could be decreasing due to the affordability of housing being at the lowest it has been since just before the 2008 global financial crisis, and in general, just people not being able to afford to buy a home right now. As I mentioned before, due to inflation and the cost of living increasing, this is obviously making it harder for people to get money together to buy a house, and it's making a lot of people just generally worse off financially. So that's kind of the updated housing data that we are seeing in terms of what's actually happening and what's happened in the last month or so. But it is also important to look at some leading market indicators to see where the market could be heading in the next few months or so. So there are several key metrics I'm going to look at, and the first one is actually the 30-year mortgage rate, which has fallen to 4.99%, which is the lowest it has been for 4 months now, down from the 2022 high of 5.81%. However, this is still up from the 3.11% that we saw at the start of the year, and aside from earlier this year, you'd have to go back to 2011 to actually reach a period of time where the 30-year mortgage rate was higher than this 4.99% today. A high mortgage rate is not a good thing for demand, as the higher the mortgage rate is, then the more expensive it is to borrow money in the form of a mortgage, meaning that mortgages are more unaffordable and more unattainable for people. Essentially, higher mortgage rates limit how much people can actually afford to spend on a house, and a rising mortgage rate puts downwards pressure on house prices. So I believe that we could see mortgage rates go back up above the 5% range in the future, especially if inflation does continue to rise, which will cause the Fed to continue to raise the interest rates, which in turn will raise the mortgage rates. So we haven't yet seen inflation top off. The latest point that we saw was the highest it's been so far. So until inflation gets fully under control, then I personally believe that this 30-year mortgage rate is likely to continue to go higher. And then to follow on from this, mortgage purchase applications are down 16% compared to just a year ago, while the seasonally adjusted index was up 1% week over week. Now, this does make sense to see the weekly increase, given that there has been a slight drop-off in the mortgage rate, which is making the cost of borrowing money for a mortgage a little bit more affordable for people. However, we are still down significantly from the number of mortgage applications that we were seeing a year ago. Also, Google searches for homes for sale are down 24% compared to this time last year. However, they are also up 9% since late May. So this again suggests that we may be experiencing a slight upturn in some leading market indicators, but the trend is generally heading down, and it is still down year over year. We've also seen that touring activity is down 7% compared to the start of 2022. This is also compared to a 15% increase this same time last year. So in general, touring is not looking too good right now. So there are obviously less people looking around houses right now, which does suggest that there are less serious buyers that are looking to make a purchase compared to what we were seeing 6 months ago or so. So I think it's quite possible that due to the pandemic, where a lot of people had increased disposable income and also interest rates and mortgage rates were extremely low, we have actually pulled forward a lot of housing demand. So I do think that people who would have bought in 2022 or 2023 ended up actually buying ahead of schedule in 2020 or 2021 because the pandemic essentially accelerated the buying decision, and this is now starting to leave a big gap in demand where these buyers potentially would have been if it hadn't been for the pandemic. So that is all for today's video, guys. Obviously there are some slight upturns here in certain metrics, especially the forward-looking metrics, but despite that, overall it is not looking too good for the housing market. There's definitely a lot of weakness in this market, which is only continuing to trend downwards. House prices are continuing to fall, and it's going to be very interesting to see where this market ends up, or where this market goes over the next 6 months or so, and actually if house prices continue to fall or if they start to stabilise. This video is purely based on my own opinions from my own research though, so it's not financial advice and I'm not a financial advisor. It's for purely entertainment purposes only. But with that being said, guys, please leave a like if you did enjoy the video. That does help out a lot. Also be sure to drop me a comment, let me know what your thoughts are on the current housing market state and where you think it could be heading in the next 6 months. Be sure to subscribe as well if you want to see more videos similar to this in the future. And apart from that, guys, thanks a lot for watching.